Ladies and gentlemen, good day and welcome to Oriental Carbon and Chemicals Limited Q1 FY2024 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Akshat Goenka, Promoter and Joint Managing Director of OCCL Limited. Thank you, and over to you, sir.
Good afternoon and a very warm welcome to everyone. Along with me, I have Mr. Anurag Jain, CFO, and SGA, IR advisors. We have uploaded our results and investor presentation for the quarter ended 30th June 2023 on the stock exchanges and the company website. Hope each one of you have had a chance to go through the same. OCCL has started the year with revenues of rupees 110.4 crores in Q1, a degrowth of 20% year-on-year due to less sales of insoluble sulfur and correction in sales price of both sulfur and acid, consequent to reduction in sulfur cost. We had seen a pent-up demand during the same period last year as things were coming back to normalcy post-COVID. Currently, we are seeing lower demand in Europe due to the prevailing economic conditions over there. However, EBITDA and PAT stood at rupees 32.6 crores, a growth of 15% year-on-year, and rupees 15.3 crores, a growth of 9% year-on-year respectively. The CV industry is expected to grow mid to high single digits during FY24. The positive impact of the promising monsoon and the government's ongoing efforts to boost infrastructure are favorable for the commercial vehicle industry, despite challenges posed by high interest rates, fuel prices, and inflation. Overall, sales momentum is expected to remain healthy, driven by improving fleet operators' profitability and gradual freight hikes and rising fleet utilization. In FY2023-24, Indian tire manufacturers anticipate making an investment of rupees 5,000 crores, driven by the growing demand from both the replacement and OE markets. The domestic market shows strong demand for radial tires serving passenger and commercial vehicles owing to several factors. Our company is a research-oriented enterprise dedicated to producing top-quality products that result in superior offerings for our customers. Our ongoing investments in sustainability, efficiency improvement, and product quality exemplify our commitment to progress and environment. We have ambitious plans to expand in geographies like North America, aiming to increase our market share. Concurrently, we are striving to increase our share in the Indian market. The demerger that was proposed and approved by all shareholders is now awaiting approval from the NCLT. The next hearing date is scheduled for 11th October 2023. Now I would like to hand over the line to Mr. Anurag Jain to update you on the financial performance of the company.
Thank you, Akshat. Now I will take you all through the standalone financials of the company. Total income for Q1 FY24 stood at rupees 110.4 crores as compared to rupees 137.9 crores in Q1 FY23. Reduction of 15% due to less sale of insoluble sulfur and decrease in prices of acid consequent to reduction in sulfur cost. EBITDA for Q1 FY24 stood at rupees 32.6 crores as compared to rupees 28.4 crores in Q1 FY23, a growth of 15%. The EBITDA margins had improved to 29.5% for Q1 FY24. Profit after tax for Q1 FY24 stood at rupees 15.3 crores as compared to rupees 14 crores in Q1 FY23, a growth of 9% year-on-year. PAT margins have improved to 13.8% in Q1 FY24. With this, I would like to open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Aditya Khetan from SMIFS Institutional. Please go ahead.
Sir, thank you for the opportunity. Sir, my first question was on to the recently, so we had expanded the capacity of 5,500 metric tons of insoluble sulfur. What is the utilization level that is operating currently? And secondly, what are the plans for the next phase of second phase? Are we planning to go ahead with that expansion or not?
So our current capacity utilization is below the optimum level, so expanded capacity is not getting used as of now. We are hoping that we will get additional orders in the beginning of the next quarter, next year. And once we see those orders coming in, then accordingly we will plan for the phase 2 expansion.
This orders you have said will come the next year, FY2025.
Normally, internationally, there is an annual cycle of addition of new plants, allocation or orders. So these plants fructify by the end of this year, and then we will know by December that what is the fresh orders that we have got.
So currently, sir, we would not be operating that capacity, or like what would happen for full fiscal FY2024?
So currently, we do operate that plant, but overall the capacity utilization is not enough to have all the lines operational at the same time.
Okay. Okay. And sir, so this is largely because of the demand impact in US and Europe. Is that one of the big reasons? Or you expect that to this?
That is a very significant reason that there has been a degrowth in demand in Europe and elsewhere also. That's one of the significant reasons, apart from the fact that we are looking to get into additional markets.
Okay. And sir, since we would not be planning to ramp up the volume, so but our fixed cost would go up on quarter-on-quarter basis. So you expect this 28 to 29% margins which we have reported in this quarter. So how much like downside we can expect from this level?
It is very difficult to comment on because, these margins are dependent on many factors. The raw material cost, the exchange cost. As far as our fixed costs are concerned, obviously, as we had indicated earlier in our conference, they are not expected to go up in any significant manner once we for our next phase also. But the margins are dependent on so many things. It's very difficult to predict what they are going to be for the year, but we expect them to be better than last year.
Okay, sir. So there's one last question. So what is the current supply position globally, and which are companies globally which are looking to expand, and what would be the capacity supply figure in the next 2 years, if you can quantify in terms of detail?
So, as far as installed capacity is concerned, it is in excess of demand as of now. And as far as current expansions are concerned, the one that we know of is Ishikoku in Japan, which is expanding by 10,000 metric tons. They have announced the plan to expand by 10,000 metric tons.
And China concerned, they are also expanding?
I think they are replacing rather than expanding. So once they expand, they are going to shut down their older, less efficient capacities also.
Okay, so the net capacity addition wouldn't be that much, right? If you are talking only 10,000 is added by Shikoku.
That is what we expect.
Okay. Thank you, sir. That's it for me.
Thank you. Participants, you may press star and one to ask the question. Next question is from the line of Akshada Deo from Vivo Commercial. Please go ahead.
Hello. Thank you for the question.
I'm sorry to interrupt you, but
Am I audible? Hello?
Yes.
Yes, please go ahead.
Yes. I just wanted to understand how we would be looking forward in terms of growth guidance on the insoluble sulfur capacity for the rest of the year.
Growth guidance for capacity?
Growth guidance for the company, top line.
Actually, currently we do not give anticipated annual numbers because of competitive reasons. But as I have said earlier, we do expect additional orders to come in by the end of the year, which should augur well for Q4, and in that manner, we should expect a growth in quantities over last year.
Okay, sir. Okay. Thank you so much.
Thank you. Next question is from the line of Dhruv Muchal from HDFC Mutual Fund. Please go ahead.
Yeah, thank you so much. One question is just if you can throw some light on the demand situation right now. And is the weakness in demand also to do with the inventory issue that we are seeing in some of the other sectors, or it's probably the underlying demand is a bit weak? And also I was just trying to understand, I believe last few years were difficult for us because of the higher sulfur and the freight cost, and exports to Europe probably were impacted.
Sorry, I missed your next question. After weakness in demand, I couldn't hear that clearly.
Yeah, weakness in demand. So, if you can please speak something about that, what's causing this? Is it because of the inventory issue in the system, like we see in some of the other chemical sectors, or what's causing this?
So,
Is the underlying demand actually also weak that way?
So weakness in demand obviously is a mixture of few things. As we did see a correction in inventories in Europe, for example, where there was a sudden reduction in consumption of tires because of slowdown. In domestic as well, there was some impact on account of inventory correction. Though in domestic it could be a little more temporary, so because once the inventory is corrected, then it should pick up. But in Europe, it will be difficult to say that.
Mm-hmm. All right. And last few years, there was some impact on us because of the higher sulfur prices, also probably globally that was, and also because of the freight rates increase. Our exports to Europe had got a bit impacted because of the higher freight rates. Now, this thing has normalized to a large extent, I believe, more than normalized, I think now. So how is our competitiveness to Europe now? Assuming the demand there recovers back, I mean, are we back to the earlier stage that we were in terms of our competitiveness to Europe, or still there is some, issues still pending in terms of resolution?
So you will notice that, in spite of reduction in top line, we have registered an increase in EBITDA. And one of the major reasons for that is the correction of international freight, which does make us more competitive as far as the international market is concerned, whether it be Europe or other countries. So that has been one major upside where we were losing on margins in the international market. As far as sulfur is concerned, there too we have seen a correction in prices. They have come down now to the normal levels, and that has also benefited us by restoring some of the margins, which had come to very precariously low levels in the same quarter last year.
Got it. So, okay. So, what we are trying to say is the EBITDA improvement is slightly lower volumes.
Yes.
Which in a way reflects that. Okay. So, can you give any sense on how low the volumes will be on a YY basis?
Normally we do not share volumetric figures because of competitive reasons.
But it will be what, more than 5-10% or in that range?
No, we are not expecting a decline in a year-on-year situation because we are very much in the running to get a bunch of new businesses. And if we manage to secure those orders, then there would probably even be an increase from last year.
On a full year basis.
Yes. And if the orders don't come and we don't want to look at that kind of situation, then it's very difficult to predict, where it will land up, because it all then depends on the demand situation.
And you mentioned about additional order flows. So the additional order flows will help you in terms of increasing the expanded capacity. This is not for the next stage of expansion.
Well, in a way, it's both, because it will help in the first stage of orders that will come, will help in utilizing the existing capacity, and at the same time, it will be a trigger point for completing the expansion.
Just to summarize, I mean, this demand weakness that we're seeing is, in your view, is not because of some significant increase in competitive intensity by somebody else, or it's purely just normal market conditions, how the demand is moving, right?
The significant increase in competitive intensity has already happened over the last 2-3 years, and that is, I think, now been baked into the system. So there is no fresh new competitive intensity that is coming up.
Sure. It helps. Thanks a lot. Thanks for all this.
Thank you. Participants, you must press star and 1 to ask the question. Next question is from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, I'm trying to understand what is the net debt of the company as on today.
Next.
Net debt. So net debt of the company as of yet.
So as on 30th June, we are net debt free. We don't have debt as on 30th June.
Sir, and net cash?
That we'll have to calculate, but on it, you have to.
On 30th June, our long-term debt was 89 crores.
Okay. Sir, and what is the cash you had, including mutual funds, etc.?
No, if you're talking about cash and net debt, then we are positive. We're net debt positive. We don't have any debt.
Okay. Sir, and
I'd like to also clarify that our short-term and long-term debt combined is less than the surplus cash and investments that are there in the company.
Sure. And what percentage of our insoluble sulfur sales are to non-tire sector?
It is very insignificant. Mainly more than 50% is tires.
So is there no other application of insoluble sulfur or any intermediate product that we are manufacturing, or any possibility of some kind of a forward integration?
So insoluble sulfur is majorly used in tire or tire-allied industries only, though it is used in other applications as well, but the consumption there is very less. So it's not significant enough to talk about.
Sir, now that the freight cost has come down, so how is our cost of production? How does it compare with our competitors in like Japan or China and other geographies?
So freight cost is basically what makes us competitive while we export. As far as the cost of production is concerned, it's nothing to do with freight cost per se. However, while we talk about competitiveness vis-a-vis China and Japan, though we do not have any idea of their production cost, because this is all very confidentially kept by them, but we do feel that we are competitive as far as costs are concerned. We are competitive enough to compete with them.
Sir, and how is the demand looking broadly in terms of, we already second quarter is going by as we speak. So are you seeing any improvement in demand vis-a-vis the first quarter, or is it the same, or actually the things have gone down?
In export, we are yet to see any improvement in demand. per se, as far as the total market is concerned. And in domestic also, we do not see any significant upside as of now.
So basically, things remain as they are, or have they further gone down as compared to Q1?
No, I cannot say that they have further gone down, but we do not see any very encouraging signs of improvement either as far as demand is concerned.
But if we look at least the domestic tire industry, if you look at their first quarter results, they have given all-time high numbers, both for the top line as well as for EBITDA. So why is it not circulating down to our company?
No, see, when we look at our company, we are looking at a mixture of exports as well as domestic market. And though we have not lost much quantity vis-a-vis last year in domestic market, but there has been an impact in the exports. So that is what has affected our top line.
Okay. Thanks. That's all from my side. And sir, just one request. So since the company is net debt free, kindly consider a share buyback, because maybe this is the best opportunity to acquire and extinguish our outstanding shares so that the earnings per share can increase permanently going forward. So thank you very much.
Thank you. Participants, you may press star and one to ask a question. Next question is from the line of Samaj from Alpha Wealth Advisors. Please go ahead.
Yeah. Hi, am I audible?
Yes, go ahead.
Yeah. So basically, my first question would be that we had previously planned to increase our penetration in the North America markets. So currently, what the penetration would be, and what are our plans for the next 2 years? What kind of penetration should we see? And lastly, have we added any new customers on the North America front?
So in terms of approvals, our penetration is very good. As we had said last year also, we have got good approvals, and we have only added to those approvals in the past year, and that is a very important step in getting the allocations. Now the time is coming up in the next few months for those approvals to be converted into actual allocations, and we will be certainly putting our best foot forward.
Okay, so any customer you can comment on that if you will?
No, I can't comment on specific customers.
Okay, and one last question would be, sir, on the realization expectation. Like directionally, can you tell me for next 2 years what it will be like?
All I can say is that till the global demand supply situation does not improve further with underlying demand going up, the situation is not going to be so easy, and things will be there under pressure.
Okay. Thank you, sir. All the best.
Thank you. Next question is from the line of Samarth Singh from TPS Capital Group. Please go ahead.
Good afternoon. Thanks for the opportunity. I missed the first part of your opening commentary, but I think you mentioned something about demand from Europe.
Sorry, can you repeat, Samarth? I didn't get you.
I think the first part of your commentary you mentioned that we have to see demand weakness in Europe.
That's correct.
I want clarification on that, because as per the EU new car registration data, registrations for the first half of calendar year are 18%. So I would have thought that we would at least, if not positive commentary, we would at least start seeing some sort of stable commentary coming out of that.
Yeah, but actually it's not happening, and if you delve deeper into the news, you will see that a lot of the European tire companies are actually facing various kinds of strife. I don't want to take specific names of our customers and the results and the various issues at the factories, but you will see that is happening. I don't know what the exact reason is. That maybe the replacement demand is what drives the sales more than the OEM, maybe things will improve. There is also a little bit of destocking going on from inventory point of view. So it's difficult to say.
Okay, got it. That's helpful. And last question, plans for cash flow for this year, which is continued debt pay now?
That's correct. Our cash flow plans remain as we've announced. Debt payoff, expansion, CapEx, and dividend. There is no other plan. The decision on whether we are starting our expansion or not will be taken by the end of this year. And we in this first few months of this financial year, we have continued to prepay debt, which is coming due over the next 12 odd months. And yeah, that's what we'll keep on doing.
Thanks very much.
Thank you. Next question is from the line of Aditya Khetan from SMSS. Please go ahead.
Thank you for the follow-up. So regarding to your opening remarks on to the new orders which we are not getting for the new expanded capacity. So is there any new geography which we are targeting or any new customer like which we might have been added? So there is likely chance of getting order from that particular geography or particular customer. Something on the cards, or we would see the utilization ramp up to around 2 to 3 years from today?
We are in advanced stages with pretty much all customers across all regions. So if you ask me about the pipeline, it's strong. But from pipeline, it has to be converted also. And that is the stage we are at with a number of customers and a number of geographies.
Okay. And so this expansion, so before like expanding the capacity, so generally a company follows an approach so to fill the order book, so pre-hand only, so whenever the capacity to commercialize. But here, sir, it seems like so we had expanded the capacity, but we're not having orders with hand. So how is the approach like which we keep generally while doing business?
You must remember that between the decision to expand capacity and today, the 2 to 3 years of COVID happened. The global auto slowdown also happened in 2019. So the external environment changed a lot. Now, I don't think it would have been prudent to suddenly stop expansion midway.
We had a year of 2021-22 also. So that 2 years also, sir, we were not able to fill the capacity of 5,500 tons. So that I want to understand more.
No, we were not. That's it. I can't shed any more light on it. We were not. In fact.
Okay, sir. Onto the cost side, so when we look in FY23, so more or less, so the power and fuel cost, the freight cost, each and every cost has been rationalized and they are operating at the normalized levels. So now with the crude prices again going up and things pick up on the inflation front, is there any chance that our cost will again go up, freight cost on this thing?
So as far as in the future is concerned, it's very difficult to say because most of the inputs are dynamic and are not very much long-term forecastable. For example, sulfur, it has corrected, but in the current month it has gone up again, though not significantly. Same for oil and freights. But what we can say is that they have rationalized, and we hope that they stay there or they move with inflation. That is our hope.
Any guidance around to the margins if you would like to share for fiscal FY24 and FY25?
It will be very difficult to say because the margins would depend on 2-3 factors. First of all, how the raw material and the exchange behaves, and on the quantity of material that we get for new orders. So that will determine the margin for FY23-24.
Okay, sir. Got it. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Manisha, individual investor. Please go ahead.
Sir, thanks for the opportunity. Sir, what is the global size of the insoluble sulfur and the domestic size, and what it is growing at a CAGR for the what it will be growing at a CAGR for the next at least 3-4 years, approximately, if you can answer.
The domestic size should be around 27 to 28,000 tons per annum. That should be the figure of domestic demand. The global demand is very difficult to ascertain because the numbers are not published anywhere, and even if different tire companies have different consumption ratios. But just give me a moment. Let me take this. It should be between 275 and 300,000, I think. Around 275,000.
275, and you told India at 27,000. That means India is 10% of the global market?
Yes. The global Indian market, our estimate is very accurate. As far as Indian market is concerned, as far as global market is concerned, it's an estimate that we have.
No, so the estimate says that you said that 275,000, right?
It could be between, yeah. So it could be between 260 or 300. I would put a hazard at around 275.
And sir, at what pace it is growing approximately? Both the markets?
So historically, what the analysts say is that the market should be growing between 3 to 4%. But current situation is not the same because of slowdown in Europe and other factors. But if you look at it on a long-term basis, this is what the analyst says, that the insoluble sulfur consumption should grow between 3 to 4%.
And sir, what should be the excess capacity in the market right now approximately?
So that number will be difficult to say again because we don't have the exact capacities of many people. But there is quite a gap. That much we know.
It should be more than 10%?
Yes, more than 15%.
More than 15%. Okay, sir. Thanks a lot. Thank you so much.
Thank you. Next question is from the line of Dhruv Machal from HDFC Mutual Fund. Please go ahead.
Yeah, thank you. Can you probably give what was the share of exports this quarter and the same number last year quarter? This is in revenue, both probably in value terms or volume terms, whatever is comfortable.
Just give me 1 moment. I will get back to you with that number.
Sure. Okay. And so the decline in other expenses, although it was almost similar QOQ, but the decline YOY is primarily driven by the what?
Decline in YOY is primarily driven by decline in freight costs. That is the biggest number there. And then decline in power and fuel cost.
Okay. The freight cost, what we are seeing in 1Q is almost a normalized number now. There's some scope left.
They have come to more or less pre-COVID levels, so more or less there.
And it's reflected in 1Q numbers. The lower cost is reflected in 1Q numbers. Yes, so that's broadly if you can share the export share.
Please, sorry, come again.
That was the only thing, sir. If you can share the export sales share.
You just calculate. I'll just give you the number.
Sure, sir. Thank you so much. Thanks.
So it was around 50% last year, and it's around 50% this year, also around 58% both days.
50% both days.
Currently, our sales turnover versus our exports turnover, total turnover is 52%, and last year was 50%.
Last year was 50%, 50, and this time it is 52.
Yeah, last quarter that is.
Yeah. Why? 123 and 124. Got it, sir. Thank you so much. Thanks.
Thank you. Next question is from the line of Keshav Garg from Counter Cyclical Investments. Please go ahead.
I'm trying to understand that what is the import duty on insoluble sulfur imports in India, and are we making any representations to the government to impose any kind of anti-dumping duty on the same?
So import duty is 7.5. Import duty is 7.5.
Ladies and gentlemen, please stay connected while we return the management back to the call. Participants, please stay connected while we return the management back to the call. Thank you. We have the line for the management reconnected. So you may go ahead.
Yeah, sorry, we got disconnected. Can you repeat the question, please? We
Keshav, I request you to go ahead and repeat your question once again, please. Keshav, can you hear us?
Okay, let's move to the next question. You can come back and ask it again. No problem.
Sure. The next question is from the line of Rajvi Shah from Moneywise Financial Service. Please go ahead.
Thank you for the opportunity. So my first question is, do we see our market
Rajvi,
share
sorry to interrupt you. Can you please speak a little louder?
Yeah, sure. My first question is, do we see our market share in going ahead, and what are your plans to increase market share in domestic markets?
Well, when we say that, from next year we are looking at additional quantities, so definitely our market share will increase. Yes, we do see our market share increasing.
Okay. And my next question is, what is the outlook on the tire industry, and with respect to the evolving trend on EV digitalization, can you share your views on the growth path ahead?
Well, as far as EV is concerned, we believe that the tires should evolve further for use with EV, and that's good news for us, because that means that insoluble sulfur utilization should go up as a percentage of the weight of tire.
Okay, thank you, sir.
Yeah.
Thank you. Ladies and gentlemen, we'll take that as the last question. I now hand the conference over to the management for closing comments.
I take this opportunity to thank everyone for joining on the call. I hope we have been able to address all your queries. For any further information, kindly reach out to us or SGA, our investor relation advisor. Thank you once again.
Thank you very much. On behalf of Oriental Carbon and Chemicals Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.